Hi, everybody. It's Danielle Damianov again here with your all-in-one loan. And I want to go over the simulator with you and show you how you can actually pay your home off in record time without making any additional mortgage payments. If you've watched my webinar, then you'll know all of the reasons this loan is amazing. I just want to be very clear. This loan is not for everybody. So if you're not, and you're going to see in just a second, if you're not somebody that cash flows every month, then this loan is not for you. If you're, spending everything that comes in every single month, this loan is not for you. Who this loan is for is people that cash flow, people that deposit money into their checking account every single month, or even have money in their savings account that's earning very little interest, and wants to be able to pay their mortgage off in record time, wants to be able to save tens of thousands of dollars in interest payments over the life of the loan, and wants to be able to tap into their mortgage, tap into their equity, without ever having to refinance. So if this sounds like you, then let's take a look at the loan simulator. What you're going to do is you're going to go to AIOloan.com or AIOloan.net. They're both basically going to be the same. And you're going to want to do a simulator where you can either compare this mortgage to the mortgage that you currently have, or let's just say that you're thinking about doing a cash out refinance because you want to put in a pool, or you're thinking about doing a rate and term refinance because you want to lower your interest rate. If you already know the interest rate on the new mortgage, or you want to compare it to what you currently have, make sure that you have all of that information before you do the simulator. You're also going to want to just do a little bit of homework to see how much money are you depositing every single month, whether it be from employment, if you're retired, Social Security, if you're taking monthly distributions from your IRA, whatever it is. Make sure you know how much you're depositing every single month, and then also how much is left over after you've paid your mortgage, after you've paid all of your debts. Let's say you put money into retirement accounts every single month. So after everything that comes out every single month from all of your spending, all of your retirement, anything that you're funding for retirement, how much is left over? So you're going to want to know that before you start. And then you're going to go to the AIOloan.com. And here there is a short little video that talks about the mortgage and how it works. And we'll click on get started here. So I am, if you're a returning user, you've already input your information, you can put your email and your last name in here, and then it will pull up all of the simulators that you've already done. So you don't really have to plug everything back into it, or you can start a new one. So I'm going to go with get started. And I'm going to compare this. I'm just going to say that I'm looking to buy a home. Okay. And I'm looking to buy a home and I'm trying to figure out, should I do a 30-year fixed rate? Rates are really low right now. And we know that the all-in-one loan is based off of the 1-month LIBOR, and that changes every month. So let's compare what we would be getting right now on a 30-year fixed rate if we're buying a home with the all-in-one. So I'm going to say that the new home is $600,000. Okay. And we're going to say that we're comparing it with a 30-year fixed. We're going to put down 20%. So the loan amount is going to be $480. The interest rate that I was quoted today or in a couple of months from now, they might be a little bit lower. They're eventually going to be a little bit higher. Let's just go with 3.875, or actually let's just go with 3.5. So let's say I'm getting a 3.5% interest rate today. That makes my monthly payment before taxes and insurance $2,155. Now, if you put down 20% on a conventional loan, you have the option to escrow your taxes and insurance or not. But when you're doing the all-in-one, you're going to pay that separate. You're going to pay that directly actually from the all-in-one whenever they become due and payable. Because remember, your checking account and your mortgage are all tied together with this all-in-one loan. So when the taxes become payable, let's say you live in Florida in November, you're just going to take that money out of the all-in-one. Remember, the way that you make your principal payments on the all-in-one is by your deposits of your income every single month. So there's no traditional principal and interest payment that's taken out. The only thing that's taken out of the all-in-one loan program on every single month is whatever that interest calculation was from the month prior. So we're not going to make any additional payments on our 30-year fixed mortgage. And we are now going to talk about income. Okay. So let's just say that you make $120,000 a year. So that's $10,000 a month. And this is the net deposit. So you want to put what you're actually, whatever your net is minus taxes. I'm just doing the gross amount right now because I don't really know what it would be. So I'm going to use $10,000. If your net after taxes is $7,000, then put $7,000. It's whatever amount is going into the bank account every single month. And let's just say that your wife or husband, whoever, brings in $3,000 a month. So we now have the borrower making $120,000 a year gross. Make sure you use your net when you're doing this simulator. And then the spouse is at 36. If there's any other additional income that you get, maybe you live in a duplex and you get rent from somebody else. Maybe you are on Social Security and you get Social Security. Whatever, any additional deposits that goes into this account, maybe it's bonus income. You can use an example of the bonus income. So whatever additional money that you have going into this account, you're going to want to put here. One of the things that I love about the all-in-one is if you're in real estate investing, let's just say that you're in real estate investing and you get rent payments, right? You have rental properties. You put those rent payments in the all-in-one. That's going to pay down your mortgage in record time. Let's say that you flip properties. Okay. Whenever you flip a home, you make 30, 40, 50, $100,000. You're putting that into the all-in-one. It's automatically reducing that principal balance for you. So the amount that you're paying on interest is a lot lower because you're only paying the interest based on the principal balance at any given day. Okay. So now we're going to talk about the percentage that's left over every single month. So let's just say that every month, okay, you are paying all of your bills, the Comcast bill, the cars, the mortgage, you're putting 10% into retirement, you're giving money to the church or charity or whatever. And every month after all of your expenses, you still have about 10% that's left over, okay? Now, some people might have more, some people might have less. And as I just mentioned, you may get lump sums at some time that you just put down to pay down that principal balance. But let's just be very conservative on this simulator here. And let's just say you have 10% left over every single month, okay? You can also, if you know that you're going to get bonuses, you can also do future lump sum withdrawals or not bonuses. If you're taking money out of the account for anything and you know it's going to be coming up, you can do the lump sum withdrawals. Okay. So this is the 10% that's left over every month after you pay, all of your bills, all of your expenses, all of the activities that you do. And so now what we're doing is we're comparing the all-in-one, okay? And we were very, very conservative here with the 3.5% interest rate and then also the 10% left over. I mean, a lot of people that cash flow have more than 10% left over. And keep in mind, whatever money that you would be using for a rainy day that sits in savings, put it in this account because you have access to it at any time. So that's automatically going to pay it down even more. But let's just say you started off with nothing and you're saving $1,300 additional per month. After everything is all said and done, the interest that you're going to save is $20,000. Okay. On a 30-year fixed rate mortgage, you're going to pay it's going to take 30 years to pay off. With this scenario, it's going to take you 18 years to pay off. So keep in mind, you have not done anything to your spending. You're still spending the same way. You are now paying your home off in 18 years as opposed to 30 without making any extra mortgage payments, without doing or changing anything with your spending. Not only are you now paying that home off in 18 years as opposed to 30, but you're saving $20,000 in interest. And you have the ability to tap into that equity at any time, whenever you need the money, whether you need to pay for your kids' school, whether you need to help your aging parents, whether you want to go on a trip, on a vacation, whether you need that money for real estate investing, whether there's a good stock option that you want to buy, whatever you want the money for, it's there for you. Okay. So you're saving the interest, you're paying your home off in less time. This was a very, very conservative scenario that I showed you. So your average monthly payment or the interest that's going to be taken out is $1,260. Okay. If you're on that 30-year fixed mortgage, not including taxes and insurance, every single month you're paying $2,155 out of your checking account. Okay. That's going to your mortgage. In the all-in-one program, every single month, estimated, they're taking $1,260 out of the account. Okay, so right there is the savings. You're also reducing your principal on average by $2,192 per month. You always have the option, there's no prepaids or anything like that, to pay more on your principal. Okay, so the principal paid $480. In our all-in-one scenario, we used, and I'll show you down here. So over here, we used an average rate of 3.5 for that 30-year fixed. For the all-in-one, we used an average rate of 5.5. We know the LIBOR right now is very, 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 very low. It's not going to stay that low forever. But if we look at the average of the LIBOR, and you can look at this online, the rate increasing to the historical average used is 5.5, but the 25-year historical average of the LIBOR is at 2.3, okay? And then you can click on the graph to see what an average 30-year fixed rate is, and then what the average is or has been on that 1 month LIBOR, okay? And then as you're going through the simulator, you're also able to just click on the little, information. So it says the principal reduction rate. This is forecasted. This is the forecasted amount of principal that's reduced on average each year as a percentage of the total principal borrowed. With the all-in-one loan, this represents home equity dollars that remain flexible and liquid, meaning you can use that at any time. Okay. So this is basically the summary of the all-in-one versus the 30-year fixed rate. Now, we did use a rate of 3.5% that we were comparing to the all-in-one. So we used the 30-year fixed at 3.5. In our all-in-one scenario, because I'm not going to use 3.5 for the all-in-one compared to the 30-year fixed, because we do know it's adjustable, we use the average rate of 5.5. Okay, so this whole scenario, 30-year fixed, using a 3.5% interest rate, the all-in-one using a 5.5% interest rate. And here's what's interesting. A lot of people, when they hear a higher interest rate, think that that is bad. But actually, what it is doing is the all-in-one is saving you tens of thousands of dollars. In this scenario, over $20,000. We're still using a 5.5% interest rate as the benchmark here, even though it would probably be in the upper threes right now. But we're just anticipating the interest rate going up to that, whether it does or doesn't, because as we can see, the average is around 2.3. But we want to give, you the scenario where if it did go that high, you're still saving money, a lot of money. You're still paying off your home in 18 years. You're still able to tap into that equity. And it's not about what your actual interest rate is. It's about how much interest you're actually paying over the life of the loan. And the reason why you're paying so much less interest, even though the interest rate could be higher, is because you're only paying interest on the principal balance. And this is the only loan that out there where you're actually paying principal first instead of interest first. And if you watched my previous webinar, you see that for a good portion, a good 10 to 12 years of the loan, on a conventional loan, you're having a big chunk of that money go towards interest, and your principal is only coming down a little bit. With this loan, it's the reverse. It's opposite. All of your checks that go in every single month are paying down the principal balance on the loan. And then you're paying interest, which is calculated daily based on whatever that day's principal balance is. So you can go through the simulator. There's all different graphs that you can save. Feel free to tweak it. If you want to use a lower rate or a higher rate on the 30-year fixed, you can. And you can really see exactly with your given scenario what you're able to, what you're able to do and how much you're able to save. And you can also save this simulator, do it a couple of different times. So that way you can compare the all-in-one with a new loan that you're looking to get, with a possible refinance, with a possible home purchase, or your current mortgage to see if it's worth moving into the all-in-one. So there's the simulator. That's how you go through it. As I mentioned in the beginning, you want to make sure you know what your net deposits are. You want to make sure that you know how much money you're spending every single month so that it can be accurate. Include the amount of money you're putting into your retirement account, or whatever your savings you're going to keep in this checking account, because that's going to keep your principal balance lower. And that's pretty much it. I think it's a phenomenal product. I'm so excited to be able to share this product. And it's really great. I mean, it's the only loan out there that you can pay principal first, that you can tap into your equity without having to get a line of credit or refinancing your home, and the only mortgage out there where you will actually pay your home off in record time, faster than a 30-year fixed mortgage, without changing a single thing with your daily spending, or making an additional mortgage payment. So if you want more information on the all-in-one loan, my name is Danielle Damianov. I'm a CMG Financial. My website is www.lendfla.com. That's lendfla.com. And I would love to talk to you. All of my contact information is on that website. I would love to talk to you more about the all-in-one to see how it works for you. Don't forget, go to AIOloan.com and do the simulator. And that's pretty much it. Thanks so much for watching. If you need any more information, feel free to give me a call or check out my website. Thanks so much. Bye.